Now, before we go into the U.S. economic data and real estate, just to remind you, please like, share, subscribe. Your support is appreciated. So when we look at the IHS market composite, you can see that things have come down a bit. IHS flash market manufacturing PMI weaker in August at 61.2 versus the estimate of 62.3. And was 63.4 prior. So the big drop was in service, which was expected at 59.2 and came in at 59.2 and came in at 55.2. So 4 points missed, and which is an 8-month low. So then the composite came in at 55.4 versus the prior 59.9. So again, you're seeing that accelerating to the downside, and it's a mixture of what is causing that. And we want to go through and break into pieces what is causing that, because it's not prices coming down. Prices still remain elevated. They're not going up at the same rate, but they still remain at peak levels. You're just starting to see some of the backlogs come down a bit. You're starting to see production come down a bit. So you're starting to see a little bit more of a normalization when we start looking at the internals driving this going forward, which is what we continue to talk about. So this is just showing just the level where manufacturing still remains robust. Again, anything above 50 is still expansionary. And as I said with Ryan Ray, it's not that we're not expanding. I'm not saying that the economy is in a recession. I'm just saying that it's way below expectations. Expectations are so lofty and so aggressive, but we're just not seeing that in the underlying data, and then you take what's happening in the US and you look abroad. The same thing is playing out in Asia, as we talked about in segment one, same thing in Europe, which we talked about in segment one. And in both of those, we'll talk more in segment 4 and 5. So then when we look at, the U.S. services PMI employment's coming down. Now there's a mixture behind this, because there's also seasonality. When you look at, you're at August 25th when this is being filmed. You'll watch this on the 26th, but we're at the end of summer, so you don't need to hire people the same way you do in these vacation towns. So that's coming down. So again, you're seeing some of this normalcy, but you're still expansionary, but just barely. And this is what we keep talking about when we look at the employment data, when we look at the jobs data. As in September, when we release for August, things are just slowing. So this is where we're going to see some of these headwinds as we look at people coming back for jobs. Now, this could start to adjust, but it's going to be difficult, even though we're coming to the end of the extra benefits that expire in September, because a lot of these service companies or services in general are just not in the point of hiring at the moment. They've either hired who they're going to, or they're trying to maximize who they have to avoid some of these additional prices, which is when we look here. So the manufacturing PMI order backlog still remains elevated. Supplier delivery times continue to get worse. So backlogs are high, delivery times continue to get worse. And this is when we look at delivery times, we've seen 2 ticks, just one little positive ticks up twice going back to 2020. We're in August of 2021, and you continue to see delivery times getting worse and worse and worse. And just based on what we talked about in segment 1, that's not improving anytime soon. Well, let's look at manufacturing PMI input prices, all-time highs and trending higher. Now let's look at output prices, all-time highs, trending higher. So when you look at what are the input prices that companies are seeing and what are the output prices, what are they charging, they're still trying to pass down as much prices as they can, this is inflation. This is what prices come up at. So you buy something on August 1st, and then you buy it on October 1st. Well, this is telling you that those prices are going to go up. And this is the leading indicator, because the input prices are how a company is going to say, okay, this unit cost me X amount more than the previous month, so how much can I raise my prices to try to compensate for that? And that's when you start looking at that output price. So then when you start taking this all together, so we look at the PMI business activity coming down, manufacturing activity coming down, all the while the city economic surprise index also is coming lower. Again, all of these things are trending down, pulling a lot of this data because these expectations continue to be elevated versus what is actual. So now let's look into the different pieces and some of these projections forward. So the August Richmond Fed manufacturing declined to 9 versus 24, again above 0, but expectations were 24 and it came in at 9. And it was 27 in the prior month. So shipments, new orders, and employment component indexes all fell but remained positive. So again, more pressure on employment, more pressure on new orders. This is what we continue to talk about in terms of this underlying slowdown. And this is just putting into perspective. So new orders came down, as did backlog. So again, you're starting to see some of that backlog is being made up, but guys are sitting there saying, look, I don't need new orders right now. I'm going to wait for, this is where you're starting to get some of that, balking at pricing, trying to manage prices a bit more, but this is also regional. So you have to aggregate it all together. So not everyone's going to be the same, but you're starting to see some of this come through the system as manufacturing wages in Richmond hit a new high going back to 2005. So this is where they're seeing prices go up, but the question is, how do they try to manage that? And that's where you're seeing some of these wages, but you're also seeing some of these prices, which is being reflected in that market flash data. And it's also being shown here. So prices paid still remain slight downtick, but just stopped going up. So it's still elevated, but prices received still went vertical because there's that difference of what did I pay and what can I try to receive? What can I pass through? And they're still trying to test that market. So then when we now flip over, let's go to Philly. So Philly Fed index continuing to cool, but still elevated. So in August, came in at 19.4 versus the estimate of 23.1 and 21.9 in the prior month. Prices paid higher along with new orders, work week and prices received, shipments lower, and 6-month outlook weakened. The good news is the employment expanded. So you saw employment go up, but when you look at the outlook got worse, prices continued to get worse. Again, all of these leading to more inflation. So when you look at manufacturing prices paid, slight uptick, still remaining at near all-time highs, but prices received. So again, there's the difference between prices paid and prices received. They're still trying to pass on some of that. And if you look like right here, the prices paid is sitting at 70, prices received is sitting at about 57. So there's still more to try to pass down. And that's why they expect prices received to continue to go higher as they try to get it much closer to prices paid, given that deviation from prices received and expected prices received. So then when we look at Philly inventories continue to go negative and new orders have ticked up a bit. So this inventory, they're done selling out of inventory. They continue to struggle, which again is going to bring in more prices as we talked about in segment 1. We talked about in segment 2. These prices continue to get passed on. They continue to get filtered through, and the drop in inventories is going to continue to drive prices up. So when we talk about inflation, we talk about prices, we have to look at the 10-year. So the 10-year auction allotment statistics show that foreign demand was at a decade high. So that's a net positive because it means that, okay, well, maybe the Fed can start to back off because we saw foreign and international, and we saw a rebalance back into U.S. goods. We've seen the U.S. dollar and treasuries continue to get whittled down in FX reserves. So now as reserves come back up, they need to, again, as we said in segment 1, they have to address inflation. And in order to address inflation, you need a certain amount of security. How are you going to get security? Well, you're going to have the US dollar as your reserve currency. So you're starting to see a bit more adoption of US dollar and US treasuries being used to support currencies. And this is something that as rates go up in emerging markets, as rates go up abroad, they're going to look to try to find ways to stabilize their currencies, and the easiest way is to take in additional debt. And based on how we're spending, there's going to be a lot available. So then when you look at, why not take advantage where the sale of junk bonds for first-time issuers year to date is at a high going back to 2005, and then the high-yield bond refinancing is at a high going back to 2005, because why not take advantage of what is happening right now, which is record low yields, record low rates. So if you're high yield, you can come in at 4 to 7%, depending on your business, depending on your balance sheet. So why not? And if you have high yield debt at maybe 8 or 9%, and things have gotten a bit better or maybe not any worse, and you can get a bid at 5%, why wouldn't you refinance? And these are the things that are continuing to go on all the while. And congratulations, Fed. This one's for you. 77 counterparts take 1.14 trillion Fed Reserve repo, new record, and we aren't even at the month end yet, because month end and quarter end and year end is typically when you see a bigger rebalance. So the fact that we're already at 1.14 going into month end, is because we're at August 25th. As we get into the end of August, 1.2 is now within spitting distance, and it's the most likely place to get hit. And that's when, even though we see RRP at a record level, so the reserve repo is at a record point where banks are taking their liabilities and stuffing them with the Fed, even at that level, draining reserve balances. So reserve balances with Federal Reserve banks continue to go at a record pace, continuing the liabilities and movement. So even with that, things continue to worsen. Now, when we turn to the real estate market, so as we start to get towards the end of the moratorium on evictions, on bankruptcies, you're starting to see the seasonally adjusted basis where people are starting to make up some of these payments, trying to get closer to out of arrears, because they don't want to lose their homes once this officially expires. So we're starting to see that come down. FHA loans, obviously the most at risk, those are going to come down, but it's going to be difficult to see them close that gap, just given where they are in their job hunt. Some of these individuals are going to stop receiving their extra benefits, extra payments, which is going to eat into their ability to get back in front of it. So then when we shifted a little bit bigger, mortgage delinquencies continued their decline in 2Q as a percentage of all loans. Total fell to 5.5% versus 6.4% in Q1 and peaked of 8.2% last year. Foreclosures continued to fall, to 0.51%, obviously because foreclosures aren't there yet. As we start to come out of this and you start to see some of these foreclosures, we expect this to tick back up to more historical norms. But the market remains so hot that we have to look at new family houses sold, not started, continues to be elevated, and family houses for sale not started, because essentially there's this, the home builders are sitting there saying, look, I got the permit, but raw materials are elevated. I'm not sure what the market's going to look like. Before I start this project, I want to try to pre-sale, and you're starting to see this get to that frothy level that we saw back in 05 and 06. So this is going to be something to watch in general as we continue to see, some sort of trying to balance. Well, let's test the market, and I'm not going to build it yet. I'm going to let people decide, because once they decide, then I can lock in their price. I can lock in the price on my raw materials. And I, as the home builder is taking less risk, because it's just going to be a marriage of, look, I'm going to hedge. I'm going to charge you more because I know I'm going to take one of my raw materials right now. I'm going to charge you what that is. And then I'm going to be able to lock in that delta. So then July new homes medium sale prices rose 18.4% year over year to a record high. So the average price is $390,500. So we are now within spitting distance of 400, which ticked up to when number of new homes for sale ticked up to 367,000. So we have more homes coming on the market, more new homes coming on the market as we continue to get this drift higher, more closer and closer, with essentially $391,000 for a new home. So when you look at the general backdrop, so now the fall for July housing starts, so 7%. So again, this is the mixture of housing starts coming down. Pre-sale is kind of the focus. So July housing starts were down 7% versus the estimate of down 2.6%. And was up 3.5% in the prior month. Building permits was a different story. Again, the building permits were up 2.6% versus 1%. So this is what we were talking about. Get the permit, pre-sale, then start. and you're just not seeing them start ahead of selling it because they want to try to test the market and they don't want to saturate it to the same way, which is providing some of that disconnect between the two. So we expect to see, again, permits grinding higher as housing starts remain sluggish. So then when we look at new privately owned housing units under construction, the under construction continues to go higher, which again is why they're looking to cool off or hold off on some of these new builds, because they want to make sure that this can all get taken down. All the while, U.S. new one-family house sold, continues to come down a bit. Survey was for 697, the actual 708, but you can see we're coming back below kind of what that trend was. And then the new one-family housing months of supply continues to trend higher as we start to get back into a bit more of this normalcy after we saw a lot of these homes come off the market. Now, this is trying to tie all this together, because you look at new home sales by price. Well, look at where things are. We're the 200,000 below is essentially negligible. And we've seen a huge collapse in 200 to 299,000 because we're seeing this big push, or over 50% is now essentially 399 and above, which is becoming which is why it's driving up that average as we get more homes that are being sold at the top of that bracket. So then when you look at the U.S. average loan size, it's marrying where we're seeing these prices. So now the average loan size is $402,440, but the down payment has also come down, but the payment for the mortgage has also come down, just given the 30-year rates. So 30-year rates. So even though the loan size is up, the cost of that loan size has been steady over this time period. But again, this is why there's been the ability to increase the asset price, because you've had this inflation, because people have still been able to get this loan even at because the prices have the actual cost of it has stayed the same. So now the high cost of renting, again, coming back into inflation, where costs for new leases skyrocket as apartment hunting gets competitive. So you're seeing, again, leases going back up. This is that backdrop that's going to push and support this increase in inflation. So then when we look at the chart, 65% of investors think inflation is transitory. So when we look at August, they're starting to get some of this movement, where per Bank of America latest global fund manager survey, 65% of respondents still think inflation is transitory rather than permanent, down from 70%. And again, as we continue to see these prints of inflation remaining elevated, that's going to, again, adjust some of this a little bit more. And you're starting to see people search for it. So the type of inflation coming, the expectation is for stagflation, which is what we've been talking about for the last couple of months, where we're going to get inflation giving way to stagflation, not deflation. And that's why we talked about those Fed prices. When we looked at the regional prices, we look at IHS, all of these are leading indicators for pricing. What is going to be the cost to the consumer? Is it going up? Is it going down? And it continues to go up. It's just not going to go up at the same pace, giving way to stagflation versus inflation. So then when you start looking at single family homes, so existing home sales up 2% to 5.99 million in July. Midwest, South and West were up. Northeast was flat. Single family was up 2.7%. And then housing inventory was up 7.3%, 2.6 month of supply is still very low, but getting there, while the median price continues to trend higher. So it just gives you an idea of how we've really come off the low from 2010, where existing home sales rose again for the second month, up 2% in July, which is the 4-month high, as we continue to see medium selling prices. So now this is looking at medium selling prices, was up 17.8% year over year to 359,900 or 360,000, with inventories up 7.3%, most since October. So then you look at July, new home sales rose 1% versus the estimate of 3.7%. When you look at just the sale, you can see just the general slowdown, even though seasonally this is when we typically see a pickup, but a lot of that was pulled forward as people look to get out of their urban homes, their urban apartments, and go into the suburban and the rural side. As you saw that, a lot of that was pulled forward. So on a seasonal level, we're seeing a bit of weakness. So then when we look at home builder sentiment as continues to come down, even as housing starts have, again, kind of normalized, coming back full circle to what is the expectations and why we're seeing some of these permits. And we're seeing permits versus new housing starts coming down. Sentiment is starting to teeter a bit, which is why they're saying, let's just test to see if I can sell this before I build it. And that's where we're starting to shake out, which means that we're starting to get to a little bit of a cooling as we head into the slower period on the seasonally speaking in the fall months. So now after going through the U.S., we're going to pivot and turn to Europe and go through some of the European data that's come out recently and what does that mean for not just Europe, but also the U.S. and into Asia. So stay tuned for more.